Welcome back to our On Credit video. Strong financial positions among consumers and corporations, along with falling oil prices, have reduced the vulnerability of the private sector, greatly reducing the risk of recession. In this constructive investment regime, we believe U.S. Treasury yields face upside risks, while high-yield spreads face downside risks. We're essentially underweight U.S. Treasuries, and particularly dislike the 1 to 3 year sector, given the implied aggressive Fed rate cutting cycle. We're, on the other side, overweight high yield, and particularly like the double B rating, given attractive yields compared to investment grade, but with limited downside. We have seen some early evidence that the manufacturing and the housing sectors are recovering after years of poor performance. If the recovery takes hold, we could see the U.S. growth outlook strengthen, which could support cyclical sectors that have lagged for years, such as transportation, consumer cyclicals, materials, even small caps. Although elevated trade uncertainty may lead to a slower activity this year, growth is likely to re-accelerate into 2026 as financial conditions have largely returned to pre-Liberation Day levels, while the tax incentives seen in the Big Beautiful Bill are likely to accelerate CapEx, R&D, and even manufacturing. Let me now switch to Rafael. Were there any interesting comments from the companies that were reporting this season that you cover?
Hi Alejandro. The earnings season was okay. Overall, top and bottom line were better than expected in both emerging and developed markets. The auto industry in the US has been the most impacted by tariffs so far, but we had other companies saying that they start to see some pressure in the third quarter. We are monitoring the impact on margins, but so far it has been limited. For emerging markets companies that we cover, it's the same story. The impact of tariffs and sanctions had been small, and the contributions from local markets have improved. Corporate balance sheets remain strong, and credit spreads returned back to tight levels, in line with those that they were trading in March, before the sell-off in April after Liberation Day. I believe that they should trade in a range in the short term. The main risk is a recession, but that risk is low in our opinion. We still like basic materials in both emerging markets and investment grade, even though tariffs uncertainty remains a risk for the sector. We are also overweighting communications in developing markets, given the yield levels and spread to other sectors. Back to you, Alejandro. What are your thoughts on the latest US earnings season?
Thanks for the question. Second quarter reported earnings are growing around 12% compared to a year ago. This is the third consecutive quarter of double-digit growth and a full 2-year period of uninterrupted expansion. Almost all companies have reported this season, and earnings have exceeded estimates by about 8.4% above the 10-year average of 6.9%. Even more positive was the consistent increase in profitability, with the net profit margin rising to 12.8%, exceeding the level seen last year, which was 12.2%, as well as the 5-year average of 11.8%. Despite record uncertainty related to trade, earnings and profitability remain strong, possibly due to anticipated purchases by consumers and an inventory buildup by companies ahead of Liberation Day. However, companies do not really appear too worried, as the percentage of companies providing negative guidance for the next quarter was only 49%, well below the 10-year average of 61%. Out of 11 sectors, 10 are showing year-over-year growth in revenues, except energy, which is reflecting consistent downtrend seen in oil prices since Russia invaded Ukraine in 2022. Technology remained the top sector with 15% growth rate, followed by healthcare, which saw a healthy 10.8%. The term recession was cited only 4% of the times in earnings calls, much lower than the 14% 10-year average, and basically confirming our view in general that recession seems to be a relatively low risk. Sectors with the most mentions of recession were real estate, financials, and industrials, but even those were around 7 to 10%, which is well below historical averages. Now, let me switch to Marcelo. How do you see the current investment backdrop in terms of what strategies that we're following despite upside risks to inflation and tight credit spreads?
Good question, Alejandro. After Jay Powell's speech last Friday, the market repriced rate cut expectations. Financial markets are now pricing in 5 cuts in total in the US by the end of next year, with 2 cuts now in 2025 and 3 cuts in 2026. The first rate cut could come as early as in mid-September. When we look back at previous cycles, rate cuts tend to be positive for credit. But very important, as long as there are no financial shocks, and the economy does not go into a deeper recession. In 2008 and 2020, returns were actually negative, despite the fact that the Fed was cutting rates back then. But it's important to remember, we had the global financial crisis in 2008 and COVID in 2020. Before these shocks, credit markets were performing well when the Fed was cutting rates. That is our base case now. The economy should be okay and companies are performing well. That should be good for credit asset classes in the coming months. In fact, I just wrote about this topic in our weekly Globe publication. There are a lot more details in the article for those interested in this topic. Going to specifics, as you pointed out, Alejandro, we are focusing on BBB and BB credits. That is precisely the intersection of investment grade and high yield. We are targeting yields in the 5 to 7% range, which we think are attractive for the solid credit fundamentals. When it comes to duration, we are focusing on bonds maturing between 2030 and 2035. In the past few weeks, we saw some steepening in credit curves. That basically means our preference has shifted a bit towards bonds maturing in 2035 within this 2030 to 2035 range. As a final comment, we also like to remind investors that yields are still high and above inflation. We think it makes sense to take this opportunity and lock in these high yield levels we currently have.
Marcelo and Rafael, thank you very much for your insights. I also want to thank our audience for joining us. If you have any questions, please feel free to reach out to a banker or an investor.
Este vídeo tem finalidade exclusivamente informativa. Não constitui pesquisa de investimento nem aconselhamento financeiro e nenhuma recomendação ou orientação financeira está sendo oferecida. O conteúdo do vídeo não leva em consideração os objetivos de investimento, a situação financeira ou as necessidades específicas de nenhum investidor. As opiniões e pontos de vista expressos neste vídeo podem divergir daqueles de outros departamentos ou divisões do Itaú e de suas afiliadas.